Why people should never do their own rollovers. The litany of errors that accumulates in the transferring of retirement assets should provide a cautionary tale about the damage people can do when attempting a 60-day IRA rollover on their own. People with the best of intentions are frequently erroneous. In such cases, those affected find themselves with unintended taxable distributions. Just some of the errors I've seen are: 1. Not getting the funds back into the IRA within 60 days. This is critical. If the post office delays the delivery by a couple of days, you could be liable for not complying with the 60-day rule. The IRS takes a very dim view of giving exceptions to the 60-day rule. Basically, they don't. Number 2, trying to do more than one rollover a year. This is a fairly new requirement from the IRS. You're only allowed to roll over once in a 12-month period. I've seen someone try to keep using the funds by transferring them from one IRA to another, delaying 60 days, then depositing it into another IRA. The next day withdrawing it and keeping it out for another 60 days. Bottom line, you just can't do it. And number 3, a lot of IRA or 401k providers will withhold 20% of the funds for tax purposes. If the full amount is not deposited, then it's considered a distribution with all the penalties and taxes assessed. Here's an example of what I mean. You withdraw $200,000 from an old 401k. The company custodian withholds 20% or $40,000. You go to deposit the remainder and you only have $160,000. You must make it whole or the full $200,000 to deposit, or it's considered a distribution. You'd get your $40,000 back when you file for your taxes next year. So unless you have a spare $40,000 lying around, you're in trouble. The short answer: when you're doing a rollover or any other type of transfer, call a professional like myself to help you. It can save you a lot of pain and financial anguish. Our phone number is 817-444-8402.